Hello, this is Dave Shepson. I'm an accountant and accounting instructor. I've been teaching for a few years and put together a series of videos to help with review or introduce certain accounting subjects and tasks that you're going to run into. This series of videos is on closing the accounting cycle. So the first thing we want to do is kind of review what the accounting cycle is. Here I've got it visually laid out as a cycle because this is what it is. You start at one point and you end at the same point by the end of the month. And everything, of course, starts with a source document, which then we analyze those and make a journal entry. And the debits and credits that are on those journal entries are posted to the general ledger. You may remember those being visualized as T accounts. And then, based on that, the balance in those accounts at the end of the month, we total up in a trial balance. In a trial balance, all the debits should equal all the credits. And then we make adjusting entries, and we'll talk more about that in the next video. And that yields an adjusted trial balance. We're going to use a tool called the Worksheet to create our financial statements, and then we make our closing entries, have another final trial balance, and it starts all over again in the next accounting period with source documents. So the worksheet is where you are going to put pen to paper to figure out exactly what it is you need to do. So we start with a trial balance, and what we're going to do is just extend several sets of columns off to the right from our trial balance. And you'll notice at the bottom, of course, the total debits equals the total credits. And this is just a simplified version. This is the first part of what's called the worksheet. There are several other columns off to the right, but I didn't want to make it too small for you to be able to read. We do our adjustments. You'll see there's a set of columns for adjustments and then adjusted trial balance. And I like to do the adjustments in a particular order. There are a couple of items that we are going to know what the ending balance is, what the adjusted trial balance should be, and we're going to have to figure out the adjustment. Most other items that are adjusted for, we're going to have some other information that tells us to adjust and what it is, and we're going to have to calculate the adjusted trial balance. The two examples that I gave here are supplies and inventory, and these are items that, based on an end-of-month inventory, we should know the dollar value, which would be our adjusted trial balance. So if there's a difference between that and our trial balance, then we would need to make an appropriate adjustment. In the case of supplies, we record those as an asset when they're purchased, and if I have an $800 trial balance debit and I know I'm ending with $650 based on my physical inventory, that means I used $150. And of course, to reduce that debit balance, I need a credit entry. The offsetting entry is going to be down at the towards the bottom. You'll see supplies expense, and we're expensing that much because that's how much was used during this period. The same thing is done with inventory, and it doesn't matter what your method is, whether it's a periodic method or perpetual method. I'm going to assume that we've finished our process, but then we always do a physical inventory. And when we find that there's a difference due to shrinkage or something, that offsetting entry you'll see at the bottom is going to be posted against cost of goods sold. And of course it makes sense that our expense entries would be debit entries. That's the normal balance of an expense account. The next set of items are going to be items we have some specific information on. For example, let's take letter C. We started out with $750 of unearned revenue, which is a liability. Someone paid a deposit or something towards a job, and now at the end of the month, we know we have earned a portion of that. So a project manager comes to you and says, you know, we've earned $250 of this. And so we're going to reduce the unearned revenue, and of course that would be done with a debit entry in the adjustments column. And the offsetting entry to that would be to show the revenue. We have now earned it, so now we're going to show that revenue in the period in which it was earned, and that goes to sales. We may also know, just because of a depreciation schedule, that we have $5,000 of depreciation on our equipment for the period. Well, we're going to add to our accumulated depreciation another $5,000, and we're going to show the depreciation expense down at the bottom. And all adjustments are always for non-cash expenses. The one item you will never see adjusted in adjustments is cash. The purpose of adjustments is to recognize revenue and expenses that wouldn't have been recognized from source documents, non-cash revenue and expenses, and make sure that we've recorded everything for the period. And they're always going to adjust either an asset or a liability account. Now we'll see that at the very bottom of our adjustments column, we should go ahead and tally up our debits and credits, and they should match. And that's one error checking tool that the worksheet gives you. If your debits and credits don't match in your adjustment columns, then you made something wrong. Perhaps a math error, just wrote a number down wrong, or put something on the wrong side. The next thing I like to do, though, is just carry my balances over once we've made all of our adjustments. And I like to work in a very simple order. So the first thing I do is look at all the accounts for which there were no adjustments and just carry those balances over. Just watch your columns and make sure if it's a debit balance, you're carrying it over to the debit column of the adjusted trial balance. So here we have cash and equipment, accounts payable, etc., that we're just carrying the balances over. Now I'll point out accounts payable, salaries payable, those are items that you could have adjustments for. I just didn't do it in this particular example. So then we bring over those totals, and then we are going to sum our items that had adjustments. So I say sum because you may be adding, you may be subtracting. If you have a credit balance to start with in your trial balance, like the example of accumulated depreciation here, this first item, and then you have a credit adjustment, that means you're going to add the two because they're on the same side, and you should end up with a credit balance in the adjusted trial balance, of course, that's higher. But in the example, say, of unearned revenue, you've got a credit balance in the trial balance because it is a liability. That would be the normal balance. And we're reducing it because we have now earned some of that. So we're reducing it, and then we're showing the revenue. And so our adjustment is a debit entry of $250, and that is going to yield, as you can see, a credit balance of $500. And of course the balance is going to be, if you have a debit and a credit, a difference between your trial balance and adjustments, the balance is going to be on whichever column the larger number is. The other thing you should be able to verify is that in your trial balance and in your adjusted trial balance, all of these accounts should have a balance on their normal side. In other words, which side of the accounting equation do they live on? So all of your assets will have a balance on the left side, on the debit side, other than your contra asset account, accumulated depreciation. And all of your liabilities will have a balance on the credit side, on the right side, as will your capital or equity accounts, except for your contra equity account draws. And then, of course, your revenue would have a balance on the right side, as will your expenses on the left side. So we will do the same thing and pull these up, and we should again get matching debits and credits on our adjusted trial balance. Now that is the goal. Really, that's the beginning of the useful part of the worksheet, is to get these numbers in our adjusted trial balance. These are the numbers we're going to use to then make our financial statements. But before we do this, what we probably want to do is use our adjustments column and go ahead and just record our journal entries, our adjusting journal entries based on this. And that's one of the uses and time-saving features of the worksheet. So I can just look at my letter A and I can see that I have a credit to inventory in the adjustments and a debit to cost of goods sold, and I can go ahead and make that journal entry if I've referenced them the way that I did here. So now we go to make financial statements based on our adjusted trial balance. And financial statements are the whole point of financial accounting, to give us those reports that we can then use to analyze a business. You'll notice that the accounts in the adjusted trial balance and in the worksheet in general are laid out in an order, and they're laid out in the order they are in the financial statements, and they're grouped by the type of financial statement they would be in. And this is very intentional. It's so that you can use this to create the financial statements. just using this worksheet. And so the first items we have are all balance sheet items, our permanent accounts, assets, liabilities, and equity. And then at the bottom, we have all of our income statement items. And these are revenue accounts and expense accounts. So all I'm going to do at this point, there's really no math involved. We're just going to carry over balances into the correct set of columns. And the first one is the income statement. That has to be the first, and we'll show you why in a minute. So I'm just going to shorten the worksheet down to the items we're looking at. We're looking at the income statement items, and I'm just going to transpose those numbers directly onto the income statement. Now you'll notice if you total them, like say subtotal them, you're not going to have equal debits and credits. And that is going to be normal because normally it would be highly unusual that you would have exactly the same amount in revenues as you do in expenses. So there's going to be a difference. What I do is go ahead and skip a row, and what I have there is my total is at the bottom row. I take the largest number and carry it down. So in this case, in the income statement set of columns, I'm taking my 10,050 debit balance and bringing it down, and I'm just using that same number on the credit. And then what I'm doing is I'm solving for what do I have to add on the right side, in this case, to bring that number up to 10,050. You're going to have an adjustment on either the left or right side, and it depends on whether your revenues are higher than your expenses or the other way around. In this case, our expenses are more than our revenues, so we have to add $2,600 to get the right side up to the same amount as our expenses, which means we had a loss. And remember that number because that's going to be important and come into play momentarily. Keep in mind, this is the reason why the income statement has to be done first. We need that number. Now we're looking at the balance sheet items, and I'm going to do the same thing. I'm just going to carry them. And again, if I total these up, where I have kind of the subtotals, you'll notice that they don't balance. And that is because income has to be closed to equity. We know it's going to affect equity, and in this section we're going to show you how it gets close to equity. But you'll see that I have to add a figure to get them to balance. Well, if I do the same thing, take my largest figure and drop it down to both columns and solve for what do I have to add, coincidentally I'm going to end up with the same number as I had for net income or net loss. And so that's another error checking thing. You should come up with the same difference as you did for your net income and net loss. That means you did everything right. Now if it's a net loss, I'm going to have it showing there on the debit side. If it's a net income, it would be showing in the right column, and I would have to adjust that up to get to the right balance. And this would not be in the worksheet, but I'm just going to show you this to prove it out. If I took that 2,600, what I have in the left set of columns is originally I had 44,600 in my capital account. If I took my 2,600 and reduced the capital account by that amount, it would be a debit entry to capital. I would get a new balance transferred over to the right side of 42,000 in the capital account. And I've just kept all the other numbers the same. And you'll see there that it does balance now, my debits and credits, so the balance sheet balances. And in actuality, that is not going to be my final number in the capital account, because what we're going to do is the draws are also a temporary account, and they're going to reduce capital account. So really, I would have $1,000 less on the left side, and also $1,000 less on the right side. So we would have $53,450 of total debits and credits with a final capital account balance of $41,000. Well, then I can use all these numbers, and I have everything I need to transfer them directly and create my balance sheet, just like I did with the income statement.